Build your dreams, live rich, and leave rich.
Today, we're going to talk about a force so powerful it can create fortunes overnight, but also destroy lives in a single afternoon. We're talking about financial leverage. Think of it as an amplifier, a tool that can take your investments and rocket them into the sky, or slam them into the ground with terrifying speed. In this explainer, we're going to dissect this double-edged sword piece by piece, using solid financial principles to understand how it truly works.
So here's how we're going to break it down. We'll start with the absolute fundamentals: risk, debt, and assets. You have to know these. Then we'll dive straight into financial leverage itself. After that, we'll see how it's used in the real world of the stock market through something called margin. And then we'll enter the real danger zone, the world of derivatives. And finally, we'll wrap it all up with a clear conclusion on how you should think about debt in your own financial life.
All right, first things first, before we can even talk about the complexities of leverage, we need to be speaking the same language. So let's lay a solid foundation with three of the most important words in finance: risk, assets, and liabilities.
At the very heart of anything to do with money is one simple, unavoidable truth: risk. There are just no guarantees. Every single investment you could possibly make carries with it the chance that you could lose the money you put in. That's the price of admission if you want a chance to grow your wealth.
Now, this slide shows you the two sides of your financial life. On one side, you've got your assets. These are the things that put money into your pocket or grow in value over time. On the other side, you have liabilities. These are your debts, the things that take money out of your pocket. Building wealth is all about managing the balance between these two. And this is where the idea of risk stops being just a number on a screen and becomes terrifyingly real. It's one thing to lose money in the market. It's another thing entirely when you use something essential, like your own home, as collateral, as a guarantee for a loan. If you can't pay that loan back, you don't just have a financial problem. You could lose the roof over your head. That is the real power a liability can have over your life.
Okay, so we've got our foundation. Now let's get to the main event. We're going to talk about leverage, the act of using borrowed money, a liability, to buy an asset. This is where things get really powerful and really dangerous.
This is the question everyone asks, isn't it? As we get into leverage, this becomes the most important question of all. Where do you draw the line between a smart financial move and a reckless gamble? How much debt is just too much? Well, luckily, there's a way to measure this.
So here's the definition, plain and simple. Leverage is using borrowed money to invest. And the risk is spelled out for you right there. Financial assets can be volatile. Their prices can swing up and down like crazy. And when you're using borrowed money, you feel those swings much more intensely.
To actually measure this risk, we use something called the leverage ratio. Think of it like a financial health checkup. The math is simple. You just take your total liabilities, everything you owe, and you divide it by your total assets, everything you own. The number you get tells you exactly how much of your financial world is built on borrowed money.
Let's put some real numbers on this to make it crystal clear. Let's say you have 65 lakhs in assets, your house, your investments, everything. And you also have 13 lakhs in liabilities, maybe a home loan or a car loan. Well, you divide the 13 lakhs of debt by the 65 lakhs of assets, and you get a leverage ratio of 20%. What does that mean? It means 1/5 of everything you own is actually financed by debt.
Please read this quote carefully. This is probably the most important warning we're going to discuss. Making a risky investment with your own money is one thing, but making a risky investment with borrowed money, you're playing with fire. You are literally compounding your risk, creating a situation where one bad trade can completely wipe you out.
Okay, so the theory is clear, but how does this actually work in the real world when you're on a trading platform? Let's get practical and talk about a word you've probably heard thrown around: margin.
So when you hear about trading on margin, this is what they're talking about. It's not a fee, it's a deposit. Before your broker will lend you money to make a leveraged trade, you have to put down a percentage of the total value yourself. It's like a good faith deposit to prove you have some skin in the game and can cover your potential losses. And this whole process is very structured, for a very good reason. As you see here, first, you, the trader, pay that margin deposit to your broker. Your broker then takes that deposit and gives it to the stock exchange. And the exchange holds it as a safety buffer. It's a chain of security designed to make sure one person's bad decisions don't crash the entire system. And here is a direct warning to every new investor.
It is so tempting to jump into things like options trading because you hear these incredible stories of huge profits. But as this source material warns, doing that without a deep, real understanding of how they work is a guaranteed path to losing your money.
All right, now we're moving into the deep end of the pool. If margin trading is like wading into the water, trading derivatives is like diving off the highest board. This is where leverage becomes its most extreme and its most dangerous.
The most important word is right there in the name, derivatives. A derivative isn't the actual asset. You're not buying a stock. You're not buying gold. You are buying a contract whose value is based on the price of something else. And this little bit of abstraction is what allows for such insane amounts of leverage.
This quote sums it up perfectly. It highlights the brutal, perfect symmetry of derivatives. The reason you can make such high returns is because the leverage is so massive. But you can't escape the other side of that coin. The potential for higher and much, much faster losses is just as massive.
I want you to just take a moment and read those words. Theoretically unlimited loss. This is not an exaggeration to scare you. With certain types of derivative trades, if the market goes against you, there is no ceiling, there is no limit on how much money you can lose. You can lose more money than you have in your account. It is one of the most chilling truths in all of finance.
And the danger isn't just about the price moving against you. As you can see here, the risks come from all directions. There's counterparty risk, the chance that the person on the other side of your bet just can't pay you. There's liquidity risk, the nightmare scenario where you want to sell but you can't because there's no one to buy. And that's not even getting into things like fraud or system failures. It's a minefield. So, after all these serious warnings, is debt always the bad guy? Is leverage always a mistake? Not necessarily. The secret is to understand it as a powerful tool, not a crutch to lean on. Let's pull this all together and come to a final verdict.
And this leads us to the most practical question of all. We've seen how dangerous it can be, but we also know that professionals use leverage all the time. So when is it actually a smart move to borrow? What does a responsible, intelligent use of debt actually look like?
This slide gives you the clearest way to think about it. Good debt is when you borrow money to buy an asset that's likely to grow in value, like a house, or something that increases your ability to earn more money, like an education. Bad debt, on the other hand, is for everything else. It's borrowing for daily expenses, for things that lose value, or worst of all, for high-risk gambles in the market.
And so we end right back where we started, with a choice. This is the fundamental question of leverage. It holds out the promise of incredible rewards, but that promise is always tied to the shadow of catastrophic risk. Understanding that trade-off and being brutally honest with yourself about how much risk you can truly handle is the first and most important step you can take in your financial